Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to the BREW, Building Relationships Every Week. Thanks for tuning in today. For those of you joining the BREW for the first time, we like to start the BREWcast by celebrating today's National Day for June 23rd. Today is National Detroit Style Pizza Day. Today, we celebrate the pizza that was born in the birthplace of the American automobile and Motown. Detroit-style pizza dates back to 1946 and sort of resembles Chicago-style pizza. It's square and starts with the toppings at the bottom, covered with cheese, and then topped with sauce. Fun fact, Detroit-style pizza is made in steel square pans that were borrowed from the auto industry. Today, grab yourself a square of Detroit-style pizza. Today on the BREW, as part of our industry advocacy series, we have Bill Shelow, who serves as president and CEO of LIBRA. E4, we're proud members of LIBRA partners, and we get to visit with Bill quite often. Today, we wanted to share this benefit with you, our esteemed producers. Today, Bill will share his thoughts on the industry, forecasted trends, and where opportunities exist in the financial services world. Feel free to use the chat box below while Bill is live. I'll be keeping a lookout. Also, all attendees are in a drawing for a prize, and we'll be announcing the winner shortly. Thanks for tuning in. And without further ado, I'm passing the mic to Dan Peterson, who serves as our president here at E4, to kick off the conversation with Bill.
Well, thank you, Abby. I appreciate that and look forward to a slice of Detroit-style pizza. We are privileged today to have Bill Shelow. This is going to be a little bit of a state of the union or state of the industry kind of talk today. And I'm really pleased to have Bill share with us. Bill has been instrumental in our industry. He has served as a senior vice president in marketing and sales for an insurance company, as well as being president and chief operating officer for Harleysville Life Insurance Company before he went to LifeMark Partners. And then about a year and a half ago, Bill was instrumental in helping LifeMark Partners and BREW, Brokerage Resources of America, merge together, forming a real juggernaut in the insurance industry. We're pleased to be part of about 60 different insurance agencies like E4 that have joined together in a partnership to bring better products, services, technology to our advisors, as well as bringing the strength of our carrier partners. When it comes to the brokerage space, we represent over 10% of all life sales in the United States as a group, and that gives us really strength with our carriers that we work with and best of class service. And Bill has been really instrumental in bringing that to the table. So we thank Bill for being with us today. For those of us who are, all our Big Ten fans, which we have a lot, we're going to introduce a new Big Ten fan here, as you can see in his background with his Penn State graduate. So for our Wisconsin and Ohio State and Minnesota folks, bear with us, but Bill will bring us a great message here. So Bill, without further ado, thank you for your leadership, and I look forward to having you share with us a little bit about your insights into our industry. And we're about halfway through the year, and bring that to us, please.
All right, thanks, Dan. And I want to welcome everybody and thank Dan and Brendan and Abby for having me here today. It's always a lot of fun to get to talk to folks that are working with our partner firms. And being a Penn State grad, and I've said this to Dan, that we will take all bets on Big Ten football, when it involves Penn State. But my maximum bet is $5. I just want you to know that. I've been burnt way too many times. It is a pleasure being here. As Dan said, LIBRA is the combination of the merger of LifeMark and BREW. And, and we did that, for a couple of different reasons. One was we were looking, to increase our scale strategically. We felt pretty solid. We had a lot of added value type of resources for our partners but scale becomes important in this business, and we wanted to increase that. So the merger made sense, and it also made sense because the two organizations were very aligned from a value proposition perspective as well as a philosophical perspective. And as Dan said, I mean, E4 is a very important partner in LIBRA. We were instrumental in bringing Dan and his team on when we were at LifeMark. And I think it's important, he mentioned that we have 60 partners kind of spread throughout the country, and we do. But I think it's important for you to know just how selective we really are. I mean, the reality is we get calls every single month from BGAs that want to be a LIBRA partner firm. And I can honestly tell you that we say no a lot more than we say maybe, because we believe the quality and character of the partner agencies that do business through LIBRA is really, at the end of the day, the biggest differentiator in our organization. So I'm going to talk a little bit about the industry today, kind of, what we see, where we see it going, and what we see some of the big challenges and opportunities are. So this first slide, this is just a slide that talks a little bit about the first quarter numbers from LMIA. And, you can see that right now, the 2021 has gotten off to a really great start. The UL premiums are up 6%, indexed UL up 13, fixed UL, which, encompasses the guaranteed universal life products. They're down 11%. And that's a lot of that is just because products are less and less available. Variable universal life up 54% in premium, term insurance up 7%, whole life is up 20%. And a couple of different parts of that story. One is certainly the large mutuals are having a strong year, which is good. But another component of the whole life production is in the final expense business, and that business has grown astronomically as well. So those two components have combined to make whole life a very strong performer here so far in 2021. And then you can see when you look at the totals, the premium's up about 15%. So let me just talk a little bit about LIBRA's numbers. As Dan said, we've got some pretty decent scale in the brokerage business. We ended last year just over $400 million of life business. So far this year, you look at the first quarter, we're up 6.6%. So that's a good, strong performance, kind of lags the industry a little bit. And you're going to see why here in a second. Our term business is down about 6.3%. But our GUL business is down 38%. So when you look at that impact of things, that has driven some of those numbers. Our indexed universal life is up 5.3. Our VUL business, we actually are a little higher than the industry. Our VUL business is up 57%. And that's where a lot of the guaranteed business has been headed to the VUL, GUL, as we like to call it. And then our whole life business is up 116%, but it's off of a very small base. I expect that, and you'll hear me talk about, I expect that segment of our business will increase pretty dramatically here in 2021. So when we look at the rest of 2021, here's what we're seeing. I've talked to a lot of carriers. I've looked at our numbers. April was okay. May was really kind of a slower month in 2021 compared to 2020, which, on the surface, you would think that would be a little bit odd. But when you think about the pandemic that hit in March, there was a huge push for our industry to get as much of the pending business paid early on while people were still kind of trying to figure out, could they see people, could they not see people? You had pending business. The one thing that that we found throughout the pandemic is this industry was particularly resilient when it came to performance throughout 2020. But like I said, there was a huge push when we look at the May of 2020 numbers to get whatever was pending, at the time in March, to get that on the books. And a lot of that culminated from a paid perspective in the month of May. So I guess it did, but maybe it shouldn't have surprised us that our May of 2021 may have lagged a little bit, that kind of spike that we saw that 1 month in 2020. I do expect our June numbers will be back on pace, showing good increases over the prior year. And I think, quite frankly, when we're starting to compare 2021 to 2020, once we get into the third and the fourth quarters, you are truly, taking a normal year, if you will, of being able to see customers, writing more permanent insurance. What we saw in 2020 during COVID was really a lot of electronically submitted term insurance applications. And as I said, we're very, very pleased with the resilience of the business. But I think what we also recognize is that now as we get into 2021, and it is more of a full sales process that we have access to, we're going to start to see in the third and fourth quarters pretty good increases over the prior year, just like we did in the first quarter. So that's what I'm anticipating for the balance of that. One of the things that was missing in the last couple quarters of 2020 were, what we would call large permanent cases, cases with face amounts of 10, 20, 30, $40 million. And it's really pretty incredible how many of those we've seen come in the door. Now, they haven't all been paid yet, but we've seen a lot of large cases come in the door so far here in the second quarter of 2021. So that's also very, very encouraging from that perspective. So let me take a couple of seconds here and go through what I think are some of the challenges that we're going to confront here in 2021 and beyond. And, the first one of those challenges is that, and everybody knows this, and everybody's tired of hearing about the low interest rate environment. And I think a lot of folks anticipated that as inflation kind of tricked up a little bit, that maybe interest rates would too, but they just went backwards again last week. So we just can't get any momentum with respect to interest rates. So this low interest rate environment now has, it has been there for, an extended period of time. And when you think about how companies manage their portfolio rates, it's through a 10-year laddering. So that, if 10 years ago you had a rate of 6% on the books, and then that comes off and then you replace it. Well, the laddering approach over the last decade has now kind of resulted in a pretty low interest rate portfolio rate experience for a lot of carriers. So, that has been problematic. And then if you combine that with the reserves, the principles-based reserves were designed to replace what many folks felt were redundant reserves coming out of AG 48. Principles-based reserves really didn't alleviate those redundant reserves. They repositioned them a little bit, but really they didn't alleviate them. And so the second thing that happened, though, was in principles-based reserve, what they did take away was for the ability of carriers to have their own captives to where they would finance those redundant reserves through their captive structure. And they no longer have that opportunity. So, what you have now is, if you think about it, a low interest rate environment, a higher dollar cost today to provide for a reserve tomorrow because of that low interest rate, and the fact that the reserves are higher than they would have been. And there's no ability to financially structure those through any other way than to, pay for those based on the current interest rate and discount factors. So what has that led to? And what that has led to is a lot of product repricing. And, we have seen that certainly with any product that has guarantees. We've seen pretty good product pricing increases. We've seen companies that have really tried to manage the mix of business between accumulation products, which don't have guarantees, and products that do have guarantees. So they try to manage that mix, and they do that by increasing the prices on the products that have the guarantees. So it slows that down, and they try to make the other products a little more appealing from a consumer perspective. Some companies have actually pulled certain products that have guarantees and they're no longer available. And we've seen that. And, and we've seen folks kind of increase the pricing on certain products with guarantees just to slow the business down a little bit. Because if you think about the strain of new business, with the low interest rate environment and the low discounting factor for reserves, which increases the dollar cost on day one for providing for that future reserve. So the strain of new business is really a lot higher today than it was at any period of time in the future. So one of the ways to kind of manage that strain, if you will, is to just slow down the business. And we have seen all of that, and we've seen all of that primarily in public companies. So if you look at the public companies that have been the biggest and strongest public companies out there, Prudential, Lincoln, you've seen real big product restructuring with those companies to, like I said, intentionally slow down the business, change the mix of business. And, we're going to kind of continue to confront that really for the foreseeable future, because neither one of those factors, the low interest rate environment or the reserve scenario, really is going to change all that much. So that cost of new business puts a strain financially on some of these public companies. And we've also seen, Elliott Capital, was, an investor that doesn't have a favorable look on the life insurance business, certainly took a position at Principal. So they're doing a strategic review of the life insurance business. These are the same folks that went into Voya and the same folks that went into TIAA. So, there's a lot of pressure of investors looking at these returns associated with the individual life business. I think the other thing that's going to happen is in 2023, you've got the new GAAP rules coming into play. So what these new GAAP accounting rules do, particularly again for public companies that report on a GAAP basis, is it almost levels the playing field between the United States, GAAP accounting and the international financial reporting standards that Europe has. So it kind of puts us on par with those reporting standards. So that's even going to be more of a challenge, I think, for public companies. So I think, the short-term expectation that we have is that, these public companies are going to be a little bit challenged in maintaining an open environment for a significant amount of new business in 2021, 2022, 2023. And my hope is that they kind of figure that out, as we go through, these financial iterations. So what does that really mean to us? And we talk a lot about this. We have 21 carriers on the LIBRA platform, and we have them for a reason. And we have them because we know that the state of this industry is always in transition. And we need to make sure that our partners have a portfolio of carriers to meet the needs for all their advisors and for all their advisors' clients. So, let's look at what the opportunities are, because I think they're great. Let me talk about the carrier opportunities first. With the public company pressure, there's other ownership structures out there that are able to have a longer term view of the business and aren't as tied to the short-term financial reporting pressures that public companies are in. And obviously, one of the first things that comes to the forefront are mutual companies. And so when you think about mutual companies, I will tell you that LIBRA just signed a contract with Mass Mutual in March of 2021. We did that really on purpose, and worked very closely with them as they were opening up their third-party distribution. We were hand in glove in the collaboration process. Some of the folks in the third-party distribution at Mass Mutual came from other companies and very good friends of our organization. So we got to play a collaborative part in how the agency contracts work, the structure of compensation, et cetera. So that's going to be a good, strong relationship for us in the future. Nationwide is a mutual company. Pac Life is a mutual company. Mutual of Omaha is a mutual company. Security Mutual is on our platform, and as is New York Life. We have the brokerage side of New York Life on our platform as well. So we've got 6 mutual companies on our platform for our partners. So I think as we encounter some of these transitional difficulties that some companies may encounter, we are very, very well positioned. Our partners are very, very well positioned with carriers that have a long-term view of the business, that aren't making short-term decisions. As I look at Nationwide and Pac Life, both have guaranteed universal life products still available. So those are all good things. So the other types of organizations I think are kind of positioned well are the companies that are owned by Japanese parents. That would be Protective and Symetra, because they're not subject to the accounting rules here in the United States. So I think those are all real positives, and we're positioned great. And the last thing I'll talk about just very quickly is, what are the sales opportunities? I mean, the business is up significantly here in 2021. And when you look at it, you've got everybody's talked about the big underserved market and the fact that life insurance is positioned a little better in consumers' minds today. So I think that has played a big part of it. The new administration, the new tax laws are going to come into play. And I will tell you that estate taxes are going to come right back to the forefront. In fact, our survivorship business so far in the first quarter, our survivorship business is up 163%, which tells me that financial advisors are already having discussions with clients about getting ready for increased estate taxes and buying that coverage now. Then you've got the 7702 changes in products, which is allow us going to put more premium in products to increase the guideline premiums. So if you're looking for, life insurance and retirement planning processes, again, a big boom for us here in 2021. All of us know and all of us believe that life insurance should be an integral part of every financial plan, whether you're in the accumulation phase, whether you're in the distribution phase, or whether you're in the wealth transfer phase. One way, shape, form, or another, life insurance can play a big part in that. And we're seeing that right now with a lot of the advisors that work with our partners. So with that, I'm going to go ahead and stop and open it up for any questions that anybody has.
Yeah, Bill, we do have a couple of questions. I know that some people are wondering about the mortality experience from COVID. I know you've helped us start a reinsurance company, and we've been part of that. So we see the mortality experience a little bit from the reinsurance side, but we've also just returned from a meeting where we did hear from chief underwriters that are talking a little bit about the mortality experience of COVID. I know the jury's still out totally on how many of those would have been claims otherwise, but can you speak a little bit about that mortality experience that we're seeing?
Yeah, so, and I will, Dan, and we obviously saw increased mortality experience, particularly in the fourth quarter of 2020 and the first quarter of 2021. We had that spike in this country in January of 2021. So we had a little spike in mortality then. And Dan is right. There's a lot of studies out there right now saying, okay, because so many of the deaths of COVID involve comorbidity issues. So like, I will tell you that, our reinsurance partner in our reinsurance program is Hanover Reinsurance Company. And, one of the views they had, now they had increased mortality for sure. And when you look at the reinsurance companies, they all experienced increased mortality experience as a result of COVID. What they're trying to determine right now is it really defined as increased mortality, or would you really define it as accelerated mortality? In other words, these were people that may have been, 84 and their life expectancy was 85, and they died from COVID this year instead of next year. So, there's a lot of kind of all of us rolling up our sleeves and looking under the covers and saying, okay, what really is kind of the impact? But there is no doubt that from a profitability perspective, COVID took its toll from a mortality perspective in the industry in 2020.
Yeah. So the next question is, even with COVID and all of the things you mentioned, that a lot of our term business last year was accelerated and electronic submission process. One of our carriers happens to be one of the ones you mentioned, Japanese owned, Symetra. Symetra has just launched an instant issue, instant approval process, which kind of is even, is that here to stay? Is that, you think there's extra risk with that, or do you think the carriers are starting to figure out how to get, 35% of the cases automated, issued within 10 minutes and a policy within 20 minutes in somebody's hands?
Yeah, so I do think that it is here to stay. I think we'll see different iterations as we get more information about it. Bestow is another company that has an instant issue process, and I think North American is their underlying company. So I do think that we're going to see more and more of that. I will tell you that I do expect that the mortality associated with instant issue will be a little higher. So even though you're seeing rates that might be comparable with street rates, so to speak, from standard products, I can tell you, having a reinsurance company in place here, that the reinsurance rates that those folks are paying for that business, those reinsurance rates are loaded a little bit. And they're loaded because of, potential adverse mortality. And carriers are able to afford that from kind of two factors. Number one, they have less underwriting expenses, so they can pay more in the reinsurance expenses. Okay, that's one thing. And then the other thing is they're expecting a little bit more business, so the profit margin may be down a little bit, but they're anticipating making that up in scale. But I can honestly tell you that the reinsurance premiums that these companies are paying for that is a little bit higher than they would if it was fully underwritten business. But they're able to absorb that through the other savings.
Well, very good. If we have any other questions, Abby, I'll let you do the drawing here. And I don't know if there is any other questions, but Bill, I really appreciate you coming on and taking the time to share with us.
It's my pleasure.
We really appreciate your leadership.
Thanks, Bill. Now's the time of the show where we have you pick a number. I'm going to have you draw a number between 1 and 15, please.
at Penn State, they only let us count to 14. I can't use 15.
14 it is. Who's the winner? Who's the winner? Steve Walker, congrats, sir. Be on the lookout for an email coming your way from all of us at E4 with a coffee card and some complimentary CE. And be sure to tune in next week, friends. We'll have our marketing guru, Tiffany Markarian, and she'll be reviewing the 4 marketing strategies all financial advisors should be doing right now. Thanks for tuning in and have a great day.
Thanks,
Thank you all.
Thanks, Bill.